Ladies and gentlemen, I would like to welcome everyone to our Transylvania lecture series. My name is Székely Balázs. I'm a senior student here at the MCC Collegium. Today's topic is inflation, which endangers our economies from Eastern Europe all the way to the United States. We are going to analyze the role of the US Federal Reserve in the managing of the problem. Today's guest speaker is Richard Werner, who is specialized in banking and economics and also is a certified investment advisor. He is a best-selling author and also a fellow in the MCC Budapest Center. Blanka Székely, a well-known television journalist, is with us to pick Mr. Werner's mind. You can ask questions via Menti. You can find the codes on your seats. Let's see what we can learn today. Mr. Werner, the floor is yours.
Thank you very much. Thank you for the introduction. Thank you for the invitation, and thank you for being our moderator this evening. It's a great pleasure.
If I have questions after your presentations anymore.
Thank you very much. Now, as we heard, I'm going to talk about inflation. And in order to understand inflation, basically, we have to understand the economy. Do we have a bit of feedback going to and fro? You know, the echoing sound. I don't know, maybe it's just in my ears. Yeah, that's the one. So, because we need to understand the economy fundamentally, we need to ask some basic questions, such as, where does money come from? Well, you tell me, where does money come from? Where does it come from? What do you think? That's better. Where does money come from?
From the government.
From the?
Government.
From the government. Any other answers?
From the banks.
Ah, from the banks.
Yeah.
What about, oh, thank you, should we? All right. So there's different answers. The government, is it the government? Is it the banks? Or, of course, another answer is a particular bank, one very important bank. The central bank. Now, I did actually a survey in Frankfurt when I was professor there with my students, and we managed to get over 1,000 questionnaires answered in record time. And one of the questions was, where do you think does money come from? Who do you think creates the majority of the money supply and makes the decision of how much to create and who to give it to? You know, who gets the money? These are important questions. How is the money created? Who gets it? Who decides for what purpose is this money used? I mean, do you think these are important questions? You can bet they are important. And of course, other questions related to this are, why do we have boom-bust cycles in the economy, banking crises, recessions, and why do we have inflation? They're all related. Now, I'll tell you the result of the survey in Frankfurt, and probably it was a slightly biased survey because we asked in the center of the city where there's lots of banks and financial institutions, the university, so probably in terms of education and knowledge, above average for the country. That's the bias. Okay, what was the result? 84% answered that the creators of the money supply and who make these decisions, how much to inject, when and who gets the money, is the government or the central bank. And that's quite reasonable to say that, because that's what you could argue makes sense, but it's not the right answer. The government creates no money. Central banks create 3% of the money supply in most countries. So who creates 97% of the money supply? Well, somebody new. Who is it? Well, we have to have a look at banks and what banks really do. Now, if you study economics, how many of you study economics or have studied economics? Okay, there's a few, maybe a bit less than a third, maybe a quarter. That's not an edge usually in understanding reality. Although I'm quite impressed in Hungary, there's some good economics teachers. But most textbooks nowadays worldwide, they use American textbooks, and it's far removed from reality. And the textbooks usually say, banks, not important, they're just financial intermediaries, they have no impact, doesn't matter, we can leave them out. And they're considered deposit-taking institutions that lend money just like other non-bank financial institutions. But is that true? Actually, it turns out when you check the facts closely, there are three theories of banking. And they've been competing for the last century: the financial intermediation theory, the fractional reserve theory, and the credit creation theory. Now, they differ in one key aspect. When a bank gives out a loan, when you borrow money from a bank, the question is, where does the money come from for that loan? Where does the bank get the money from? And each of these three theories has a different answer. There's some reading. We can have a look later, or we can post the links. The three theories have some different implications. The currently dominant one that all the famous professors in the US, for example, that author these globally used economics textbooks, what they say is the financial intermediation theory is correct. Banks gather deposits, do their analysis, and lend out the money from deposits. Do banks create money? No, of course not. Not individually and not in aggregate. And the bank regulation we get based on this approach is the capital adequacy approach we have, known as the Basel approach. That's the current system. But before the 1960s, there was an older theory, and that one has some similarities. It says that each individual bank is just a financial intermediary gathering deposits and lending out the money. So individually, banks don't create money, but in aggregate, somehow, as the banks interact, money creation takes place in the system. And they operate with something they call the money multiplier, which sounds kind of intriguing. And the corresponding regulatory approach to this is the reserve requirement, because basically each bank has to put reserves with the central bank. And that's also the source of the money when a bank lends, according to this theory, is excess reserves at the central bank. But there's an even older theory that was dominant until about 100 years ago, the credit creation theory of banking. And that one says banks are not intermediaries. Banks create money. Each individual bank, when it gives out a loan, it creates money. And of course, the banking system is the main creator of money in the economy. The source of money when a loan is given out is ex nihilo. They use the Latin expression out of nothing. Banks create it. Banks create money, which sounds pretty shocking, really, if you haven't heard this before. Of course, the corresponding approach to bank regulation is, well, if banks create money, in fact, the process is through credit creation, then, of course, central banks should monitor bank credit directly and perhaps guided credit guidance. Okay, so we've got three theories. Now, what's the scientific thing to do? If there's three theories and they say different things, what's the scientific thing to do? I mean, don't we want to find out which one is true? How do we find it out? What would a scientist do? Do some empirical test, scientific test. Now, when I looked at this, there's already this debate for a century raging on with different schools of thought saying different things. Nobody had done an empirical test. Because in economics, it's considered heresy to adopt the scientific research methodology. Economists like to use the deductive or axiomatic hypothetical research approach, the deductive approach where you just make up stuff basically. And I always think there's no reason why we can't use the scientific research methodology also in economics. It is heresy, but it works and we get interesting results. The three theories differ, as I said, in the question of where the money comes from for a loan. If you're interested, we can come back to this, but basically you can show this on balance sheets, that the financial intermediation theory, there is no balance sheet lengthening on the asset liability and the accounts of the banks. With the fractional reserve theory, it's a bit complicated, but Samuelson's famous economics textbook, which is still around in the, 25th edition, they explain it as a two-step process. And in the end, the bank loan also does not create money. There's no balance sheet extension. But the third one is the credit creation theory, where what happens is the loan given out, like in all the others, increases assets of the bank. But when the borrower gets the money, this shows up on the liability side as an expanded liability, and therefore the balance sheet lengthens. Now, because these are three different results, we can conduct a test. And I did this empirical test. In fact, there's two papers, 2014, 2016. Just look up, Google, can banks individually create money out of nothing? That is the most downloaded scientific paper of all Elsevier journals across all disciplines, apparently. You can add to that. But there's a 2016 paper as well. The conclusion is financial intermediation theory, which is in all the textbooks and most economists use for their economic theories, is rejected by the evidence. Fractional reserve theory, rejected. It's the credit creation theory that's true. You see this when you look at the law, particularly in England, which is the source of the creation of modern banking, and English law is quite clear on this. Economists say banks are deposit-taking firms that lend money. The law says banks don't take deposits and banks don't lend money. They don't take deposits because at law there's no such thing as a bank deposit. Instead, if you put your money in the bank, you give a loan to the bank. That's what it is at law. It's just a loan. You're just a general creditor. Who's the owner of the money? It's the bank. Okay, what about the loan? Well, banks don't lend money. They purchase assets, securities. If you take out a loan, you issue what is legally a promissory note, a debt instrument, and the bank buys it. And then it owes you money. And if you say, I don't care about the details, give me the money, the banker may say, you'll find it in your account with us. And that's how they do it. They book their liabilities to you as a deposit, but nobody deposited it. So, the credit creation theory is the correct one. Financial intermediation theory and fractional reserve theories are rejected. With a bank loan, bank assets are expanded as the bank purchases the loan contract, and the borrower's account is credited with the money by simply adding the numbers. The money is created out of nothing. And I could empirically show that when the money showed up, I took out a loan, a real loan, 200,000 euros. Where did the money come from? From nowhere. It was not transferred from anywhere inside the bank or outside the bank, but I got the money. So that proved it. So banks are special. Does this have an impact in the economy? You bet. This is the engine of the economy. And we've had this for many centuries. So banks create the money supply. The 97% of the money supply is created by banks. Who was the one who said banks? Hands up. Don't be modest. Well done. It is banks. That's called bank credit creation. Now, the decision of how much money to create, who to give it to, for what transaction, will reshape the economic landscape. And that is made by banks. Therefore, it's very important what type of banking system you have. Do you have a banking system consisting of many small banks that are local community banks, owned by the community, accountable to the local community? Then you usually get very good results and a very strong economy. That's what Germany did 200 years ago, and for 200 years, despite crises and disasters, managed to have a very strong economy because it had this banking system. 80% still today of its banks are not-for-profit local community banks, local savings banks, local cooperative banks. But if you have a banking system consisting of a small number of big banks, that's not going to be good because they don't lend to small firms. And what happens then we need to look at. So how does this bank credit link to the economy? You can look up the quantity theory of disaggregated credit. Basically, it's very simple. The money creation process, call it C, credit for credit, because money M is used for savings aggregates and it's very misleading, deposit aggregates. So it's actually money is created by banks to credit, so call it C. Credit going into the real economy, the green part, will drive GDP growth. Credit going into non-GDP transactions, these are purchases of assets, ownership rights in property, real estate, financial assets. They don't go into GDP, they go into asset markets, they will drive asset prices, create a property boom, and these things are always unsustainable, and that's the source of banking crises. So overall, we have only three scenarios, really. When bank credit goes into these asset purchases, it's unproductive bank credit creation, creating asset inflation, if it's large enough, bubbles. And then, of course, as soon as the bank credit for asset purchases stops, it's like the music stops in a game of musical chairs, you know, there's not enough chairs. Then the late-coming speculators go bankrupt, non-performing loans, the banks reduce lending further, credit creation shrinks further, asset prices fall further, the whole downward spiral. And we see this again and again. We've seen it 100 times in the last 50 years already. If bank credit is used for consumption, that is the source of inflation. And there's really the answer to the inflation question. When banks lend for consumption, because bank lending is money creation, you're giving new purchasing power to people, but you haven't created more goods and services. You have the same amount of goods and services, but more consumption. Well, you're going to get consumer price inflation. It's not rocket science, is it? The green box is the third possibility. That is the redeeming feature of banking. And that's when you succeed in making sure bank credit is in the green box. Then you get high growth, no inflation, no asset inflation, no banking crisis, you get stability. And of course, this is what Germany managed to do for 200 years. And Japan copied that, introduced that in Japan, and then also in Korea and Taiwan. Then China under Deng Xiaoping in 1978 introduced the same system in China. And of course, Deng Xiaoping realized we need lots of banks for this. And he switched from the mono-banking Soviet system with one bank to creating thousands of banks, small banks, local banks, credit unions, savings banks, regional banks, provincial banks. China now has almost 5,000 banks. And that creates high growth and no problems and no inflation. So that's really all you need to know to understand banking and understand the economy and understand what's going on in the economy. There's more empirical evidence on various aspects of this. You can look at various bubbles, the 1980s bubble, the US 1920s bubble, and then 30s depression. I learned this in Japan when I observed in the 90s massive expansion, bank credit way ahead of normal GDP growth, going into financial assets and property, real estate. Of course, once the credit creation slows, you have a bust banking system. For that purpose, you need bank credit then for a recovery to rise again, and that's when I proposed a new monetary policy. I was chief economist at Jardine Fleming and Securities in Tokyo, and I was the first to warn there's going to be a big banking crisis now in Japan. And then also I proposed a new monetary policy, which I called Quantitative Easing. It was published in the Nikkei, Nihon Keizai Shimbun, in September. There's the same graph, by the way, I just showed you. I already used that then. And it says, of course, keiki kaifuku ryōteki kinyu kanwa kara. All we need for recovery is quantitative monetary easing. which is defined as an expansion in credit creation for GDP transactions. What does this mean in concrete terms? Actually, I had a two-step recommendation for Japan. Step one, you ready, because they made so many mistakes, they had the asset bubble, they're going to have a banking crisis now. Okay, we can get out of it, any banking crisis, very quickly. If the central bank purchases non-performing assets from the banks, you shift it to the central bank balance sheet. That doesn't create inflation. It's an accounting adjustment. Because why should you have a recession with unemployment when it's just an accounting problem in the banking system? But of course, the powers that be like that. I want this would happen in Europe. The ECB would create this same problem in Europe, and it did in Ireland, Portugal, Spain and Greece. Spain and Greece, for almost a decade, 50% youth unemployment, a whole generation without hope to get a job. It's criminal, unnecessary. So the first step was, and a central bank could do this at zero cost to society. No tax money used, no money used. No cost to society. Why isn't it done then? Well, it is done when it suits them. But it didn't suit them in Japan, which is another story, and we can come to that. Why did they create a 20-year recession? I invented QE for Japan and they didn't apply it. Well, there's a second step. I predicted that even if you did this, the banks will still be shell-shocked and they will still be cautious in lending. But there's a way for the central bank to kickstart bank credit. That is, if the central bank purchases performing assets from non-banks, i.e. the central bank goes out and just buys things from the economy. Then everyone's bank account is essentially credited by the bank through newly created credit, and the bank is credited with the central bank. That's how it works. And that's how you can really push money into the economy. When you have deflation, bank credit shrinking, the economy shrinking, as was the case in Japan. That was my Japanese QE. Now, the Bank of Japan said, oh, we can't do these things. Nonsense, what Richard Werner is saying. In the end, 5 years later, they say, okay, we'll try this QE, but it's not going to work. And they on purpose did something else. Central bank purchase of performing assets from banks, which doesn't do much. It gives marginal profits to banks, does a bit of asset inflation, but you're not getting rid of the non-performing loans, you're not kickstarting bank credit. So they had 20 years of recession, 20 years of bank credit shrinking. I mean, I want them 20 years ago. So we've got these three possibilities of QE, the fake QE, which doesn't work, and the two QEs that work. Now, the reason why this is so relevant is that because the Fed did it. In 2008, when the banking crisis started in the US, Ben Bernanke was actually engaged in the 1990s debates that I had joined and made this proposal to, and it looks like he listened, because in 2008 that's what the Fed did. The Federal Reserve in 2008 bought the non-performing assets of the big banks, which were, they had been lending crazy stuff and had these non-performing assets. They would be bust, but the central bank purchased them at face value. Problem solved, no costs. That's why America was out of the 2008 crisis first, even though it started in America. Other central banks didn't do that. Now, what happened then in 2020 was very strange. In March 2020, the Federal Reserve did my second proposal for QE, which is totally out of place. The central bank should use this only as a form of massively kickstarting bank credit creation, pushing money into the economy for consumption. You should do this when you have deflation, a shrinking economy, bank credit negative, but that wasn't the case in March 2020. Bank credit was growing at 6%. There was normal positive inflation. GDP growth was strong, 5-6%. And they did it. Massive, unprecedented injection of money creation by the Federal Reserve buying assets from the non-bank sector. Now, I've got a few charts that maybe in the discussion we can come back to, looking at the 1970s inflation, because I can assure you that the same thing happened already in the 70s. But for the sake of time, let me go straight to what happened in 2020. Now in this graph, we have two lines. The blue one is the Federal Reserve credit creation, and the grey one, perhaps slightly hard to see, is bank credit creation, which is much larger. In 2008, bank credit was shrinking. That's why the central bank stepped in. Fed credit creation goes up. They were purchasing non-performing loans, QE1. In 2020, bank credit was already very strong, 6%, the grey line. And the central bank kickstarted its own credit creation and bank credit by an enormous amount, as if we were in a 2008 crisis. But there was no such crisis. The money supply was not shrinking. It was massively boosted by the Fed action. Now, why was that? And here's the smoking gun of what happened. In August 2019, every August, the central bankers in America, they meet in this place in America, I think is in Wyoming, Jackson Hole. And they talk shop, and economists present papers. And there's two interesting papers in August 2019. Number one, Mark Carney, he used to be the governor of the Bank of England until just about that time. He said that the petrodollar post-war monetary system is ending, and there will be a new system based on digital currencies, and we need central bank digital currencies, and we need to globally link them. That was one important point. We'll find out why that's important. Secondly, the commercial private sector asset manager BlackRock, which is the biggest asset manager on planet Earth. They manage hundreds of trillions of dollars. It's beyond imagination. Presented to the central bankers, to the Fed. They presented their BlackRock plan for the next crisis. And you can find this on the internet. It's still on the internet. What did they say? Well, surely there'll be another crisis, okay? And in the next crisis, we've got to create inflation. Literally, that's what they said. There's no justification. Why do we need inflation? No, the next crisis, we've got to create inflation. And how do we do this? We have to go direct. It's a description of my QE2 proposal. The central bank purchases assets from the non-bank private sector. That's exactly what the Federal Reserve did in March 2020, which is why bank assets went up as much as central bank assets. And how do we know that this has actually happened? This happened in March 20. Well, we've got the data, and just to make sure we know what has happened, in March 2020, the Federal Reserve hires BlackRock to purchase non-bank private sector assets for the Fed. Unbelievable. And they purchased corporate bonds, vast amounts, all sorts of ETFs, private sector assets. And of course, there were additional government measures to make sure consumption would go up. That created the inflation. So if you ask me, why did we have this inflation? And many central banks followed suit. They just copied the Fed. The Bank of England coordinated simultaneously, same thing, and so on. So why do we have inflation? Well, the central banks created it. End of analysis. And why did they do that? Because they wanted to. They chose to create inflation. Of course, that raises a number of other questions. And as I come to the end, maybe timing-wise, how are we doing?
Yeah, you should.
Okay. As I come to the end, well, why? Now, I'll give you one answer. Why did they suddenly want to create inflation? It has to do with the other paper by Mark Carney, that there's a change, a historic change in the global financial system. Because that is actually what happened in the 1970s. Maybe very quickly. The official story concerning the 70s is, we had inflation because there was a war in the Middle East. There was an embargo on energy, oil embargo, and then oil prices went up, oil supply shock, inflation. And isn't it funny that that's the official story of our current inflation? Oh, there's a war. There is an energy embargo, gas supplies, energy prices going up, and we have this supply shock, therefore we have inflation. Well, turns out, in both cases, look at the data, that does not explain inflation. It doesn't work, both in the 70s and now in the 2020s. The inflation happened before the war and before the boycotts, both in the 70s and now. The inflation was already there earlier. So what drove it? Look at what happened to bank credit. Bank credit growth expanded massively in 1971, peaking in early 73. And that's true in other countries. Germany, peaking in March 73. The war and OPEC embargo was in October 73, and oil prices only rose in January 74. But the inflation already was peaking in some countries like Germany in 73. So clearly it doesn't work. The official story doesn't work. It's the same in the 2020s. And so why did it happen in the 70s? Why did they want to create inflation? Because, you see, there was a change in the global monetary system. Until 1971, we had a gold standard. The dollar was linked to gold. But because the Americans were just printing too many dollars, and the Europeans, well, actually it was only the French because they weren't part of NATO, so they were a bit freer, they challenged the Americans, said, you're just printing dollars, you're buying up our companies, our land, everything, you give us these green little pieces of paper, okay, we'll exchange them into gold, we'll change them into gold. They sent an aircraft carrier to Manhattan, French Navy. The captain had the job to pick up from the Federal Reserve Bank of New York the French gold. That's when the Americans closed the gold window in August 71. Famous speech by Richard Nixon, look it up on YouTube. That was the US default. And America needed a new backing of the dollar because the dollar was in free fall. They realized the countries with trade surpluses, Japan, Germany, they weren't buying enough American stuff. America had a huge trade deficit, dollar was falling. What does Japan need? What does Germany need? Oil. They went to Saudi Arabia, they made a deal. We'll put the army in, we'll prop you up, you'll stay in power in Saudi Arabia, but you must only sell oil against US dollars. That's what backed the dollar, the petrodollar. But that is now ending because Saudi Arabia is now switched, is selling oil for the first time against yuan, Chinese currency. And we have a big shift, which maybe we can talk about later, but I better end this here. And you see, in the 70s, the inflation was the cover for this shift in the monetary system. And we're now witnessing the end of the petrodollar and the beginning of the new system based on digital currencies. I'll leave it at that. Thank you very much.
You cannot leave them with that because that's the beginning, digital currencies. You said people are starting to have to buy digital copyright ownerships, and previously, I don't know if today, but I read that you said that if loans go to growth, as Japan did, then progression will happen, and if in assets, consumption and bubbles of nothing, ownership, then inflation comes. But my question is, where does economics meet with anthropology and people's behavior?
Well, thank you. That's a very good question, actually. It's an interesting question because economists traditionally have not looked at anthropology, and anthropology is an empirical science. It looks at how societies and peoples behave. And so it's about empirical facts. It's an empirical science, a social science. And there is, of course, archaeological anthropology and ancient anthropology. And economists say, how did money start? Oh, let's assume there's no cash, no money, no modern money. So then what do people do? Well, they have to barter. And that's what they put in their textbooks. This is just made up story. It's not based on any empirical fact. The anthropologists have proven that the ancient money was credit. And all ancient societies have credit systems, which is really what we're talking about. So basically there's a gap between the textbook English language economics, which was created by David Ricardo in the 19th century in England, starting to dominate economics globally, and is now, of course, it's American economics has taken over. This is deductive, hypothetical, axiomatic, unscientific economics, which is basically a form of propaganda to suit certain political purposes. And on the other hand, there's empirical scientific economics, which is in line with what anthropologists have found and looks at the facts. And that one is very eye-opening. For example, economists always love to talk about equilibrium. It's just a made-up concept. There's no such thing. Nobody's ever proven that there's any equilibrium. There is no equilibrium. It's made up. In fact, it's very clear that the assumptions, which gives you the requirement for the conditions to have equilibrium, are so unlikely to ever occur anywhere on this planet that you know for sure that every market is not in equilibrium and therefore is rationed. But that's just one of many examples. So do ask your economics teachers about empirical evidence for what they say. See what happens.
The IMF says that from the last 150 crisis situations, 148 they were not predicted by anyone. Is that true, or economics did predict people, but the media never listens or does not want to listen because of political propaganda?
Yeah, I think it's probably true for IMF economists and mainstream economists. They did not predict these things. But in 1991, I'd been to Japan, went back to Oxford. The top 20 banks in the world were Japanese. GDP growth in Japan was 7%. Bank of Japan was lowering interest rates. So all the standard economists were saying, oh, buy Japanese stocks. They've fallen, they're cheap. Buy Japanese stocks. I predicted the opposite. I said, Japanese banks will go bankrupt. Japan will move into the biggest recession since the Great Depression. Sell Japanese stocks. And that turned out to be correct. So those who did listen to me, they made a fortune. There's a global macro hedge fund. This guy's a billionaire now. Hasn't given me a cut yet, but I had a meeting with him and he bet the house on it. So sometimes people listen, but mostly the media, the corporate media, is very controlled, and it follows the official story, which is fed usually by central banks.
Isn't that dangerous not to follow? I mean, there's coming a meteorologist coming and says it's going to be storm. You listen to him. An economist comes and says there's going to be crisis, and you don't. That's dangerous, and you don't communicate to people. Isn't that going to the edge, to the line, because of political propaganda? And when did that start? You say it started from the British Empire.
Yes, that's true. And of course, the British Empire started with what? It started with the Bank of England. First, it started when England was conquered by the bankers. And then from there on, they conquered the world. What's the last successful invasion of Britain? Do you know? And don't worry, most British people don't know, okay? So how can you be expected to know? But maybe, what do you think?
Falkland.
Sorry? Falkland, okay, I was not referring to, remnants of the empire that they're still defending, but the mainland, so literally Great Britain, the islands, England, Scotland. When was the last time that was successfully invaded and the sovereign replaced? Now, most British people will say, 1066, the Normans, William the Conqueror. It's not true. It was in 1688. There was a Dutch invasion funded by the Amsterdam bankers. and they drove out the Stuart monarchs who had refused to allow the creation of the Bank of England. And they brought a Dutch lowly princeling with them, made him King of England, and hey presto, the Bank of England was created. 100% in private ownership. Must be nice to own a central bank, what do you think?
And that's when the media started to shift from the economic point of view.
Yes. In fact, the next step then is, when did the Bank of England hire its first economist? It was only in the 20th century, in the 1920s, under Governor Montagu Norman. Now, this was a well-known economist, but he was hired now by the Bank of England. And this is well reported by Bank of England people. What happened in their meeting? The governor told this economist, don't misunderstand the situation. Your job, the governor says to the economist, is not to tell me what to do. Your job is
To tell people what I
people,
want to communicate.
Well, exactly, which is, so he put it this way, your job is to tell people why I did it.
Yeah.
Whatever I'm doing, why it's a good idea and why I did a great job.
Back it up with scientific information to look.
Scientific,
Yeah.
Exactly.
So I'm going back to the anthropologist's point of view because I'm really interested in it. Does greed, there's very much greed right now in the world, especially digital one, like, well, buying literal stuff that don't exist, like digital ownership, for example, and all the rest of the bullshit maybe we're buying, is that greed directly causes inflation?
Well, whenever you have, inflation is almost always based on money creation. Whenever you've got money creation not backed by the production of goods and services that add value, then you get some form of price inflation. If this money creation goes into assets, you get asset price inflation and then usually banking crisis. If it goes into the real economy through consumption, you will get standard consumer price inflation. And both is unsustainable, both causes problems. Of course, the consumer price inflation is like a tax on the majority of people. It's another way to take money from the many and give to the few. It is also usually the preferred way when a lot of national debt has been created, like we see in the US now. We've got in excess of $31 trillion in national debt, narrowly measured, because if you add pension liabilities and other stuff, it's even bigger. History shows that the most convenient way for governments to reduce that in real terms is to cause inflation. And that, of course, is the second purpose. I think also in the 70s, there was a lot of national debt for those days. And with the bout of inflation, you are kicking everyone in the stomach and they have to take the hit. And you're in real terms reducing national debt by letting ordinary people pay, which is not a good way, of course. But what we saw just analyzing the 70s and the 2020s, really, this inflation has been used to cover this change in the monetary regime. And because you keep mentioning the digital currencies, that is actually this shift that certainly the UK and US central planners would want to take. So they want to switch to central bank digital currencies. Also the ECB is doing allegedly some kind of consultation. Of course, the answer is already decided. It's like if the Soviet government did a popular consultation, right? I mean, you've got to smile. But that's when the ECB is in action. And so they're going to have this central bank digital currency, but we have to be very careful. This is very dangerous. So this new monetary system has a lot of dangers because they want to restrict alternatives like cash. And cash is freedom. You can't be monitored when you spend the cash. They don't know who is spending the money where. And that's, privacy, which is one of the human rights, actually. They want the opposite, of course. They want us to be sources for big data. They want to know where we are, how much we spend, what we spend it on. And the first step is the surveillance, and the data will be used against us. But the second step is going to be the intervention. And they're already talking about this. It's not a conspiracy theory, because they've published their plans. Central bank digital currencies can be programmable. Oh, that sounds interesting. What does that mean? Well, it's not going to be your money. I mean, technically, as I said, bank deposits are not your money anyway, but this is going to be more obvious, because the CBDC, central bank digital currency, you will only be able to spend when the central planners think that whatever you want to buy and where and how much is a good idea for you now. And when they disagree, it's not going to work. And they may disagree for reasons like, hey, climate change, we need to reduce carbon emissions. Let's all stop breathing because we're emitting too much carbon dioxide. Or, oh, you can't buy food anymore, that'll reduce carbon emissions. Well, I mean, officially, of course, they do things like, oh, you're not supposed to leave your 15-minute city area, and you're not supposed to use your car. You won't be able to buy petrol, you've already used up your carbon credits. Things like that. Well, basically, if you give central planners that much power, I mean, human nature tells us such power corrupts, as Lord Acton says. Absolute power corrupts absolutely. It will be abused. They will come up with any excuse, always for our safety, for our, health, for the good of the planet. But there will be massive interventions, and that's why we have to stop it. It's not a good idea. Plus, the other problem is central bank digital currencies will result in an acceleration of the concentration in the banking system. The small banks will be forced to merge more and more. There will be fewer banks and bigger banks, only a small number of big banks left. And we know from history, big banks don't lend to small companies. But most employment is with small and medium-sized enterprises. 70% of employment in every country, Romania, Hungary, Germany.
Are there any plans?
Small firms, and they need small banks, otherwise they won't thrive.
Do you know of any political strategies that view this thing to give more power to small banks in Europe or somewhere?
Well, I'm trying to spearhead this movement, so please support me, because that's what we need. When the central planners are trying to centralize, we have to do the opposite. We have to decentralize, and the most powerful tool is money. And because banks create money, we have to make sure every local community has their own local bank. I mean, what we should do is we should set up essentially Hungarian banks, ethnic banks, in Romania as a project, why not? And get support from Hungary.
There is one, and it's now being sold, right?
Really? Well,
the Hungarian one.
There you go, it's being sold. Well, let's set up more, and every town with enough people there should have one. 30,000, 40,000 people, one bank. That's the scale, because they can work together, they can share the back office, so it is efficient. And it works very well. If you follow the key principles, I've worked this out, been working on introducing this in England, community banks, because they have a very concentrated banking system. It's been very frustrating because the elites there are very against this. So there's been lots of opposition, interventions, and strange things happening to slow the project. But I accumulated the know-how so we can get banking licenses. We've got the know-how, all the content. You need huge amounts of regulatory, documents. But I've got that. We can do that. So maybe we should work on setting up community banks in Transylvania and so on. Why not?
why scientific data, when you analyze a situation in economics, isn't enough ever? Only scientific data.
What do you mean? Why is it not enough? For what? Or
I'm always returning to my first questions. How did people change? And why, if you apply models of saving countries from crisis, it behaves differently in years, 2008, 70s, now?
it's decision makers, and most people misunderstand the situation, and also they assume that the decision makers, the central planners, particularly at the central banks, want stability.
Yeah.
But there's no empirical evidence for that whatsoever. The only central bank that managed to have a fairly stable economy and low inflation, even in the 70s, was the Bundesbank. It made all the other central banks look bad, and you can imagine what happens to such a central bank. It'll get abolished. So they introduced the ECB, and now the Bundesbank is just the Frankfurt office of the ECB.
Yeah, so...
And the ECB immediately went out and created asset inflation, banking crisis, the whole lot, you know.
So there's a simple way to produce growth. Japan did it.
Yes.
But they stop it. This is what we would like to understand. Why do they stop growth when it could continue for decades?
Exactly. Well, the answer is this. I mean, I found out that because what preceded the Great Recession in Japan, 20 years of recession, bank credit contracting, and the central bank refusing to take the simple policies to get out of it. I found that what preceded this, of course, is the asset bubble of the 80s, a massive asset bubble. And why was that happening? Because banks were lending so much money for property, real estate transactions, massively. And then I did empirical research on this. I went out and asked loan officers of banks who in the 1980s were doing this job. And I asked them, so tell me what happened. Oh, crazy days. I was going out, contacting companies that have not even an account with us, and tell them, look, there's a property. I, as a bank, lend you the money. You buy this property. It's going to go up. You're going to make a fortune. Just here, sign. We've prepared everything. Just sign here. You get the money to buy this property. That's how they pushed out the money. So it was really crazy, he would say. Well, then why did you do it? I asked. Oh, because my boss said so. My boss is the branch manager, and he gave us a loan increase quota. We constantly had to increase lending. So next I went to the branch managers of the banks and asked them, so tell me about the 80s. What happened when you were branch manager of the bank? Oh, crazy days. I told my loan officers just to increase lending, real estate lending, massive increases. It's pretty dangerous. We're creating an asset bubble, and that creates a banking crisis. Wow, okay, so why did you do it? Well, I was told to do it by the banking headquarters, the bank's headquarters, strategic planning department. Okay, I'll go there. So I went there, met the guys, bank headquarters, strategic planning department. So what was it like? By the way, I got good responses because I was at the Bank of Japan. I had a name card saying Bank of Japan. So they were all like, okay, we have to be polite to this gaijin. And they told me, so strategic planning department, oh, the 1980s, crazy stuff. We were telling all our branches to increase lending, push out those loans like crazy. We're creating an asset bubble. Why did you do it? Well, we're told to do it. Well, by who? The bank CEO? No, they're not engaged. We are the top decision maker at the bank on this. So by who? The Bank of Japan, the central bank. It was called window guidance. The central bank would tell the banks how much to create credit. And this is all put together in the book Crises of the Yen.
Yes, that's your best-selling book. Can you guys imagine a book in economics that is best-selling? Like you read it on the beach or something, it's best-selling, and there's also a documentary that was made 7 years ago, I think.
It was great when it was out in Japan, in Japanese. In all the bookshops, they've got the top 10 books. Number 1, Crises of the Yen. Number 2, Harry Potter.
Yeah.
For 6 weeks. Then Harry Potter took over again. Yeah.
You inspired an artist, a director of a movie director, to make a movie.
Yes,
so
there is a YouTube film. But the story there, you get the full story. So the Bank of Japan wanted to create the asset bubble, and as it turned out, in order to create the long recession, to change the system. So there's a political, ideological goal to change the successful Japanese economic system. And why? It turns out it was, of course, the Americans that told the Bank of Japan to do this. They had been demanding since the early 70s that Japan should change its system. Japan was getting too successful. It needs to shift from export to domestic demand. It needs to deregulate, liberalize, privatize. But they were so successful, you wouldn't change the system. So they needed this crisis to be persuaded. And that's essentially how they blew up the system artificially, which is a pretty shocking story.
They copied it before. It was the Japanese productivity lessons, right? They were trying to take it and then being afraid of its success.
Well, basically,
it was too stable.
Basically, America could not compete. This system is so successful. And we see it, of course. Japan introduced the same system in Taiwan and Korea before 45, when these two were part of Japan. You may not know this, but until 1945, Korea and Taiwan were part of Japan. And when Deng Xiaoping came to power in 1978, he, of course, had gone through a lot, like all the Chinese people. I mean, he got arrested so many times before. They had the Great Leap Forward, which was basically creating a famine that starved more than 20 million people to death in China. It seems Brussels, the EU, is trying to do this in Europe now by shutting down farms. And then they had, that was the Great Leap Forward, and then they had the Cultural Revolution, where you're basically messed up psychologically, which they're also doing quite a lot in the US and Europe these days, you know, gender stuff and all that. Anyway, so they seem to be repeating that history. But Deng Xiaoping said, let's forget about all this nonsense, ideology. We want economic success. And he literally said in his first speech in 1978 to the Chinese Communist Party Congress, let's drop ideology. Well, it's pretty radical for a communist. Let's forget about all that politics, communist ideology stuff. And he said, let's try to be successful and let's empirically work out what works. So they adopted the empirical approach in China, which is better than what they've done in English language economics. They still don't have the empirical approach. And what did he find? Oh, we need to learn from Germany and from Japan. He traveled to Japan literally to find out the elixir of high growth. And because the Japanese, by the way, this is a hint, if you ever want to learn something important from Japan, the important thing is to go out in the evening after hours. It's off the record. They want to tell you the truth and they will tell you the truth. But it has to be off the record after hours. And usually a bit of sake helps, in vino veritas, and you will find it out. That's how he learned it. And he introduced it in China. We need many banks, founded thousands of banks, credit guidance, bank credit only for that green box for productive business investment in small firms. That's how you get 4 decades of double-digit economic growth, multiplying national income 20 times. And of course, more people were lifted out of poverty than anywhere in history before. So that's the successful system. We can have this success, but who doesn't like it? Oh, it looks like New York or Washington and London don't like it. So now China is enemy. And of course, Japan's system has been very much damaged. The goal is to dismantle that system entirely. Because it looks like they don't want us to have stable, high, sustainable, equitable economic growth without inflation and without crisis. But the truth is, we can have it in any country. What you need is many, many small banks lending to small firms, and then increased bank credit, funding entrepreneurs, implementing new ideas. There's no limit to growth. And this is not going to hurt the environment, because growth is a statistical fiction. How can a statistical fiction hurt the environment? Pollution hurts the environment. You can have pollution with zero growth, and you will have more pollution when you have zero and negative growth, which is what they're engineering in Brussels these days. Deindustrializing Germany and creating big problems for the future. That's not going to save the environment. You can have high growth and make sure that you don't hurt the environment, but you can have high green growth, of course. But it looks like there's lots of resistance against it. The central planners somehow want to, I think they feel that it gives too much power to people. If communities are successful, they have their own minds and their own opinions, and that seems to be the real problem. And that's why we need to step up against this, hold against this, and empower local communities by setting up local banks, as Deng Xiaoping did.
I think we should leave time for the questions. For you guys to ask whatever on the platform or live. They're shocked.
Is that mic to go around? I'll lend you my mic.
Let's see if we have here. You all have the code and the Menti platform, and then there you can ask. You have a question? Yeah.
So my question would be that what do you think about the fact that there was this crisis recently in the Swiss banking system, and UBS and Credit Suisse got crashed and bankrupt, and UBS took it over. What do you think about this crisis? Because Switzerland is quite important in the world of finance, even if it's a small country.
Okay, shall I answer that? Can I borrow your microphone? Yeah. Thank you. I actually have you could as well add to this what preceded this, Silicon Valley Bank. And essentially, maybe I can answer with Silicon Valley Bank, and then it's easy to talk about Credit Suisse. What happened with Silicon Valley Bank was very, very, very strange, because unusually this was a bank that was not lending for anything risky. 65% of its lending was to the US government in treasuries, which even regulators love because that's zero risk. It's considered zero risk. So how could this bank go under? That's totally crazy. It doesn't make sense. Well, what happened was the following sequence of events. People pulled out deposits over 2022. Happens. But any banker knows you respond to that by making an announcement, putting some ads on the internet, in the media. We have an offering. We're offering special savings accounts at whatever the figure is, 2.6% interest. 1 year, put your money in and you get 2.6, 3.6, whatever the figure is, okay? You need to be in the top 10 and you get a wall of money coming in. That's the basics in banking. They didn't do that. That's very strange. Are they really bankers? So that's another strange thing happened. Next, they decided to instead, because deposits were being withdrawn, to make up for it by selling their US treasuries at a loss. What? Why would you ever do that? They don't have to mark to market. They never have to sell them at a loss. They can always wait until they mature. They get 100 back and there's no risk. So why would you do that? But that's what they did, and they booked 2 billion in losses. Next, another strange thing happened. They decided, okay, let's advertise our very strange banking behavior by saying we're going to issue some equity. So all the equity analysts will now study and publicize what we've done. They will analyze everything. That's what they did. And so of course all the equity analysts said, these guys don't know banking, what's going on? So the equity issuance was a failure. And then it just took Peter Thiel, who is actually a German entrepreneur, but who's been in America since the age of 9 or 10, who's into all sorts of techie stuff, working a lot with the CIA, by the way, which is not a secret apparently. And he steps forward and says, and he's a big Silicon Valley investor in California and was a big customer of Silicon Valley Bank. He pulled out all his money from all the companies that he directly controlled and instructed all the companies he'd invested in, you also pull out all your money, and went public all on the same day, Thursday, 9th of March. and led a depositor stampede. Just add one more piece to this. The Silicon Valley Bank had joined the pilot called FedNow. The Federal Reserve had said, oh, we'll try a new bank transfer system. Do you want to join? Silicon Valley, yes, we'll join. And as a result, the transfers were out of control for Silicon Valley Bank. The Fed was in control with FedNow. And so they hold the record for the largest amount of deposits ever to leave one bank in one day. With Silicon Valley on this, what was it, 9th of March or something, Thursday. And so of course the bank was bust because its depositors left. Now you have to remember that the Federal Reserve as a central bank is quite new. It was created only 100 years and 110 years ago. Because American government, politicians are very much against central banks. And they persuaded the politicians to set up the Fed by saying that even a very strong and sound and healthy bank will go under if depositors panic and everyone simultaneously withdraws the money. That's why we need a central bank to step in that moment, because it's a good bank, and lend money to the bank and they won't go under. So the politicians are, okay, all right then, okay then, if you must, let's have the Federal Reserve. So that's how it was founded. Well, sadly, the Federal Reserve did not live up to this basic promise to be the lender of last resort. In the 1930s, it watched as 10,000 banks failed as depositors pulled out money, and there was a bank run after bank run in the 1930s, Great Depression. What about Silicon Valley Bank? FedNow was used to pull out the money and bust the bank. Did the Fed step in? No. The Fed only stepped in after they decided to close the bank. So, conclusion of this was an orchestrated takedown. There's no other explanation. There's no rational explanation. In order to be able to argue, oh, maybe these smaller banks, we should be really concerned about them. And of course, this is what the story that we hear now. Oh, can we trust these smaller banks? Well, maybe we need to consolidate the banking system. We need mergers, and that's what's happening. And then, of course, central bank digital currency will be another solution. If there's a banking crisis, put all your money into central bank digital currency, which is programmable. So you can leave the decision of whether you can actually spend the money to the central planners. Great. So that seems to be the same, and it's the same with Credit Suisse, because there it looks like the regulators were watching the stock price. The main reason why they acted was because stock price is going down and down and down and down. Now technically that's not an issue because it doesn't affect the bank's liquidity. It looks bad, yes, and of course there were short sellers that were making a fortune, and the regulator then shut down the bank. The equity holders lost all their money. The short sellers made a fortune, mainly US hedge funds, and they gave it very cheaply to the other big bank, UBS, with state guarantees. So that's another takedown, unnecessary, and has the result of concentrating the banking system. That's the wrong direction. But central planners like concentrated banking systems. That's where Deng Xiaoping was unusual. He wanted decentralization, and that was the ticket. That was successful. I mean, you could even argue in the communist era, the countries that were more decentralized and allowed local small entrepreneurs, Yugoslavia and Hungary, were more successful. I think it's true. And also East Germany was not so bad because it was one of the few that left the savings banks, the Sparkassen, alive. They didn't close them down when the communist takeover happened. So these aspects of decentralization, they always mean, you're more successful, more resilient.
Any other questions? No? One? Nem látom. Nem jött be. So there's one that came on the platform. You said that with many small banks, this is how people can ask without you knowing who asked it. You said that with many small banks, we can have infinite growth without hurting the environment. Why are more small banks better, and how can we have infinite growth in a finite system? Isn't growth backed up by technology?
Yes, maybe I should start with the last point. That is absolutely true. The real source of growth is technology. But that's precisely why there's no limit to growth. The only limit to growth is technology. What is technology? Technology is a recipe. It's like cooking. The recipe is the knowledge. It tells you which ingredients to select, in what quantities, in what form, and then how to process them following which process to get something that is superior than just the sum of the parts, the raw inputs. That's technology. And technology, where does it come from? From human ingenuity. And that has no limit. And that's why there's no limit on growth. We are being held back artificially by the central planners that keep bank credit from going to small firms that have many productive ideas. And actually, they don't even have to be the latest technologies. Small firms thrive by just operationalizing existing, recent technologies. You don't have to invent new technologies. And that's why in Germany, productivity has been higher than, say, compared to Britain, much higher. And the reason is that, let's say there's a new technology in the field of this small company. The company realized, oh wow, there's this new technology. Of course they didn't develop it, but they realized this technology is going to change our business. We've got to get it. We've got to get it and get ahead of it. Well, that will cost money. And they do the same in Britain and Germany. In Britain, well, we're never going to raise that money. The banks won't lend. These big banks only lend to big companies. That's it. End of story. Productivity stays low. They get left behind. Market share falls. Germany, they go to their local cooperative bank, Volksbank, in their local town, headquarters there. They know the company. They say, this new technology is out. We've got to act fast. We need probably, 250,000 euros now. They get it by the latest on the next day. And they stay productive. They stay ahead. And they can be so-called hidden champions. This is an interesting concept. Small firms that have top market share in their niche in the world. It's called hidden champion. Hidden because they're SMEs, small firms, small and medium-sized enterprise. Nobody knows the name. But they're the key company in that niche in the whole world. And they did research on this. And this is the countries. We don't have Hungary mentioned here. It must be under other. And this is the number of hidden champions. And Germany is head and shoulder above everyone else, even the US. And why is that? Well, I tell you, it's because of this. This is the number of banks in European countries. Which one sticks out head and shoulders above the others? It's of course Germany, because it has the largest number of banks, because it has so many small local banks headquartered locally that make quick decisions lending to entrepreneurs. That's another measure of banking, banks and bank ATMs in Europe. Where do you expect higher growth? Come on. Quite obvious.
There's not many in Scandinavia.
So, yes. So it's back to the same. So the hidden champion success story can be created by having many local banks. That explains also the Chinese success in the last 40 years.
Any other questions? It? Yeah. What do you think? What do you think about US officials saying that there is an infinite amount of cash at the Federal Reserve to calm people down?
Well, they've certainly abused that privilege of money creation in 2020, and that's what caused the inflation. But of course, by the way, I should not let you go without updating you on the latest figures, because of course bank credit creation is now down a lot in many countries, including the US. So it looks like the Fed continues its job, or what it thinks is its job, to create boom-bust cycles. So they give us a few years of inflation. It looks like it's going to be followed by another recession and deflation. And actually there was an earlier question, so I responded by talking about Japan. So why are they doing this? Up and down, boom and bust, and inflation and deflation. Why don't we get this stability?
To change the systems.
It's because there is an other agenda. If their goal was literally to make everyone better off, they would deliver stability, because it is possible. But you see, when you do that, if the central bank every year delivers 4% real growth, 1% inflation, 5% nominal growth, every year, it's possible. And the central bank governor goes through the streets and goes in the shop and asks, so what do you think is going to happen next year with growth and inflation? Oh, I know. You guys are doing a great job. We're going to get 4% growth and 1% inflation. By delivering success, the central bank gives away and gives up its power. It has no extra information now anymore. An ordinary person knows as much as the central banker. You see? But if you create cycles, that's a very different story. People get shaken around, they're surprised left, right, and center, and that's how you can get more money out of the pockets.
Assets are being sold and...
Concentrate assets, concentrate ownership, transfer money from the many to the few, which is sadly why inequality, of course, is rising when you have these constant boom-bust cycles.
Real estate booming and crashing.
Boom and bust. And of course the insiders can take advantage both of the ride up and the ride down.
As the petrodollar is at its end and the CBDC is not sounding so good, what alternative do we have? Crypto clearly isn't stable enough, so should we go back to a gold-backed currency?
I think as there's this threat of CBDCs, it's probably good for everyone to stock up on some physical gold that you have control over. It's always the question where to keep it safely, where you can get access to it. So you've got to think about that. Because it looks like if they succeed with these CBDCs, it could be a very oppressive system. But I think everyone will still accept gold. So it could be potential alternative when you need it, and you better prepare it while they still allow you to buy gold, you know.
There's many shops in the center, so opinions on NFTs. I would have asked that if it was not here.
Yes, well, the whole crypto world, yes, has pros and cons. Maybe I should start with the cons. And start with Bitcoin, which started this whole stuff, of course. Bitcoin was, of course, an important development, but I think it served a purpose, namely to start this whole business and industry of digital currencies, so that central banks could then also say, oh, we need to respond to this. That's why we need to offer central bank digital currency, a safe option. You know, and that's why, of course, there was an incentive to create Bitcoin, a central incentive. And it looks like some of the big, three-letter agencies were involved, US agencies were involved in creating it. And the other purpose of Bitcoin was, and also the other cryptocurrencies, was to create an outlet for those who would normally, in crisis situation or when they just print money like crazy, buy gold. And of course the central banks have been working hard to keep the gold price down. But if you don't have alternatives, of course it's going to be harder and harder to keep the gold price down. In the 70s it took off, and I think that's one of the lessons they took. We have to suppress gold. And the cryptocurrencies have helped in that. because a lot of people have pushed into those instead of gold. So there is that aspect that it's part of this scheme, it seems to me. But to some extent, some of them seem, well set up, and maybe alternatives that perhaps, one should have a little bit in the portfolio. But overall, essentially, we should fight for our freedom to have that, to be able to make that decision in the future also. Because of course, if CBDCs are going to be introduced, then they want to have monopoly power over this money, digital money, and everything else will be suppressed. I think we should basically fight for the freedom to have the choice of instruments that we want, and ideally prevent the introduction of CBDCs because they're centralizing.
And the NFT part?
Sorry?
NFT part?
Well, the NFT part, I mean, it's partly seems to be a bit of a gimmick. Maybe it just needs more proof that it has lasting value. I know there's cycles also in the cryptocurrencies, and we sort of went through a down cycle. It's now probably on the way up, and it could well be that all the cryptocurrencies and NFTs will pick up again. I don't know. Maybe I don't know enough about NFTs, but I don't really see the value, the lasting value.
Yeah, people are destroying real arts, work of art, saying that this my NFT is here, so we don't need that, and they're burning it. So it's.
There is one risk. Actually, just this week I found out there's a new paper by, was it the BIS, or was it, there was also a UN paper, I can't remember which one, it was one of the big agencies, and they were saying they're working on the future of central bank digital currencies and increasing tokenizations and having everything as digital assets. They're pointing out how great that is. And then I started to understand, oh, hang on, if we tokenize everything, even ownership of buildings, real estate, tokenized, I mean anything, car ownership can be tokenized. Because it also means that if it then is a digital currency type of asset, a tradable token, because these things can be controlled, that could be a very efficient way when, for example, carbon credits controls and sort of social credit scoring is introduced, for saying, oh, for these and these good reasons for your safety, we need to now control the ownership of this and this asset. All car ownership has to go into this fund now. Or all property should be owned by, I don't know, central bank or whatever. Because once it's digitalized, tokenized, you can also very quickly, digitally, in a few seconds, transfer the ownership if you have the power and control, which is what's currently being engineered to make sure that a small number of central planners have all the power and all the control. Is this really what we want?
We have a lot more questions and we don't have time. So can you give like 1 minute answers? Because
Okay.
I have a
shorter,
lot many questions and they're interesting and I would like to read it. As you said, banks are considered unimportant in mainstream educations, but they clearly matter a lot, creating almost all of the money supply.
Exactly.
What is the reason for this discrepancy?
It's not surprising. I mean, the author who wrote this seems to agree banks are important and powerful. And in fact, if you ask any person on the street, what's important in economy, usually they say money, banks, we know banks are powerful. That's a fact. Well, if that's true, and we know it's true, then wouldn't you expect there to be a lot of misinformation about this very powerful institution called banking? And that's what we have. Because it's so powerful, a lot of misinformation was created. It was started, I mentioned, by David Ricardo, an English banker who made a fortune. He was, what we today would call a multi-billionaire, and he retired in the city of London and settled down, built a big schloss, chateau, castle. Of course, in England you say a country house. We understate things. Sounds a bit like a wooden shed, but it's actually a palace, okay? Let's call it a country house. And he settled down there and he created modern economics. Of course, surprise, surprise, without any banks in it. No banking, banks don't exist. So, go figure.
How is the stock market affected by the fact that everyone can invest with ease online?
Well, of course, in theory, that should be positive for the stock market if you can make it easier to, have more people join the stock market. In that context, I would like to point out the fact that, again, we're being manipulated because lots of media and online stock channels and whatever, it's all about stocks. I mean, CNBC already 25 years ago had all the stock quotes, running across the screen. If you follow them, you go like this as you watch television. So they make us crazy going after stocks. But when I was senior managing director at Bear Stearns Asset Management or chief economist at Jardine Fleming Securities, I found out that all the big, serious money, institutional money, sophisticated money, they don't buy stocks. They buy bonds. Now, as an individual, it turns out it's very hard to buy bonds. They don't want us to buy bonds because that's for the big guys, you see. But you can make nice capital gains in bonds and it's much safer. Basically, it's far less risky than stocks. With stocks, you can easily lose everything. With bonds, if you do it right, it's a 0-1 binary thing. Are they going to default, yes or no? If they're not going to default, you're going to get 100 back. But if you've bought it for 50, you're going to double your money. When the Portuguese government bonds in 2011 were trading at 50, I put in as much money as I could. And I thought, I wish I had a banking license. I could really pile into these Portuguese government bonds because they're going to go back to 100. You double your money. In the end, it turned out they went to 145. So you have your capital gains in bonds, but you don't have the downside. So think about alternatives. So not just stocks, because they want us to go into stocks, and that's actually where there's higher risk. Think about bonds. It is harder to actually trade them because they make it harder, but it's possible, getting a bit more possible. So look into that. Government bonds, of course, but also corporate bonds.
During the last 80 years, can we say that the US was in control of the world economy?
Yeah, that's probably... Yeah, well, it's probably true. I mean, of course, there's many exceptions. They weren't in control of the Soviet economy. They were competing. There's some, but within their empire, within the American empire, in which most of Europe probably has to be included, Japan, a lot of Asian countries, Latin America, they've been very much in control of, partly directly through US institutions, partly through the IMF and the World Bank, all the developing countries. IMF and World Bank, the US has a majority vote, and they've used the IMF World Bank system to keep developing countries in a state of underdevelopment and prevent development, while at the same time claiming, we're trying to help them to develop. It's not true. The whole thing is a big con, and I can prove this if we have more time because of the rules again of banking. So all these developing countries are made to borrow money. Now, let's say JP Morgan is going to lend to South Africa. Which currency is South Africa going to borrow now from this international bank or American bank? In which currency? Dollar. Why? But that means currency risk is carried by who? The borrower or the lender? Who has the currency risk? The borrower. The developing country has the currency risk. Well, isn't JP Morgan meant to be the expert in hedging currency risk? Why is South Africa supposed to be the expert in managing currency risk? You see? But it's all in foreign currency. They borrow in foreign currency. Now, when you go through the actual mechanics of this, you find out it's a really evil trick. If South Africa borrows, say, $1 billion from JP Morgan. You know how much will arrive in South Africa of this money? 0. Because of the rules of international banking. US dollars stay in US banks. British pounds stay in British banks. Euros stay in Eurozone banks. Nothing arrives. And so in practice, what does this mean? The Finance Ministry of South Africa, they've issued the bonds. They now say, okay, wait, we've got an account in New York now saying $1 billion. Okay, the money's come in. Well, actually, we'd like to use it here in South Africa. JP Morgan, can we change this into South African rand? Oh yes, of course, rubbing hands. Of course, we'll charge a fee. We'll change it into South African rands for you. What happens in the mechanics of banking? JP Morgan will call South African banks for a quote to change it into South African rand. They don't have South African rand, JP Morgan, so they get it from South African bank. Where do South African banks get the money from in rand? They create it out of nothing. And when the money is then repatriated and used by the South African government, it's money that's created by South African banks, which you can do in the first place. They don't need a foreign loan. It's because all the development economics textbooks say banks are just financial intermediaries. For economic growth, you need savings. Oh, you don't have enough savings? You have to borrow from abroad. The foreign banks will lend to you. So you get them all indebted. They've all got this huge debt now in foreign currency. The developing countries are mostly commodities exporters. That's what the IMF and the World Bank encourage. Focus on commodities. That's your comparative advantage. Commodity prices, in the long run, fall compared to finished goods prices in relative terms, always, because of standard economic principles. Therefore, their currencies always fall. Therefore, the foreign debt always goes up in foreign currency, in domestic currency terms. They're in a debt trap. They will never get out of this. So the foreign lenders will say, okay, we'll help you. We'll lend you some more money. And maybe it's time for some debt for equity swaps, which means we're going to take your assets. You know which developing countries have no foreign debt problem? Those that have no assets of attraction, of interest to the foreign bankers. They have no foreign debt because they don't get any foreign money. So then the assets are seized, countries are taken over. That's how the show is run, and that was done through the IMF World Bank. And that's just one other example of how the US has run the show. No wonder developing countries are turning to China, which is a bit more honest about what it's doing. And is actually delivering results by building infrastructure that they can use and so on.
They say economics is telling you things that you've known your whole life, but you don't know the language. Richard is certainly translating economics to us in an understandable language and did that for the last couple of decades. Thank you for doing that here in Kolozsvár, Cluj-Napoca also for our students at MCC, and hope you'll be back.
Thank you very much. It's been a pleasure.
We didn't have time for some questions because there's more, but it would be too much. Thank you.